So I think most of you have been investors in the market. He is an investor, I'm pretty sure. You have never been a market investor, right?
Not that
Active.
yeah.
Ashok is again, I know.
I flip flop. Sometimes in the market and then sometimes I'm out of the market.
Right.
Dominant investors, then some kind of the number is looking very green, then I exit, come out, and that's it.
So he's Sunny from ICICI. He's Jaydeep. Yeah. He's Mr. Yadavar. Ashok Bansal. Mr. Kamar. Sachin. Yeah. He's my team. Sneha, Nishan, Milind, Jay. Yeah. So I thought.
Do we have a VGA cable?
Yeah.
No, but
But your presentation is already there. It is already done. So we are live on the YouTube also, Jay?
yes, we are.
Sit. Yeah. So good morning, all of you. We have pleasure to have all of you for this session. So this knowledge series is our initiative towards giving more insight on the concepts which we feel could be very helpful for the investors. So we have started this almost 3 years back, and we continue to keep doing a lot of activity around this. Thank you, Jaydeep and Zani, for coming over. So today, there is we have seen investing and emotions are always inversely correlated. So emotions are something which doesn't let you take a decision correctly. So, and we know markets are all about, sometimes, I'm sure most of you see that markets sometimes are up, down, newspapers talking something, CNBC talking something. Always there is a different kind of voices coming in. So as an investor, we always feel what to do, and can we genuinely make money out of this exercise. So we thought we do something on strategies wherein where we can be out of the emotions and make positive alpha better than fixed deposit return, tax free. So we have with us Jaydeep, who can give us more insight. Thank you.
Thank you. Thank you so much. And a very, very warm good morning, almost an afternoon, I suppose. So, yeah, the agenda of why I'm here today is to talk about this concept that we have, and it is available across the industry, called as the dynamic asset allocation. Right? The name itself should define what it does. It dynamically allocates your assets depending on where the market is or where the market seems to be going. So, with that brief introduction, I'll just start my presentation. So, since I'm from mutual fund, Axis Prudential Mutual Funds, a very happy guy, counting his money. But that is the key. That is the thing that we are trying to address. And you start becoming a little greedy. And greed might lead you to start investing more and more. Might start, making you feel that nothing can stop you, and that you might reach new heights. But that is a point wherein a emotionless strategy is better off rather than going on your own. So before that, for the benefit of everyone, let me just take you through what does a mutual fund house basically does. Right, as a mutual fund house, as an investment house, we understand that different people have different expectations out of their money. Wants to save up for, say, a world tour at the end of the year. At that point of time, the person already has the money. He just wants to park it somewhere, right? Get a few small alpha on that. He's not expecting the money to get doubled. He's probably investing at a crore of rupees. probably is expecting say 4-5% or say 6% on that. Let's imagine someone who wants to say buy a car after say 3 years. So he's going to be willing to take slightly higher risk, but again, not so much risk that he's not able to buy a car and he has to buy a bike from their point of view. And the third person could be interested in buying a house at the end of 10 or 15 years. So that person is looking at having higher risks in his portfolio. So we understand that different people have different expectations out of their money. So people who have common expectations, we pool their money together, right? We pool their money together, and this pool of money is handed on to a fund manager. So the fund manager is basically an AMC, right? We give it to an AMC who then gives it to a fund manager. That fund manager will invest these into stocks and securities depending on what kind of fund that you have agreed to invest into. That fund, that stock or security will in turn give you a certain amount of returns, right? And this return is passed back to the customer in the proportion that they had invested in the first place. So you pool money together, you give it to a fund house, basically give it to a fund manager. He will invest this money. That will generate certain amount of returns, and that return is returned back to the customer in the proportion that they had invested in the first place. So this is broadly, there's no rocket science in how a mutual fund house basically works. Now that begs the question, why so this sounds very simple, doesn't it? So you invest your money somewhere, that money gives you certain returns, and that you keep that return. So why do you need a fund house to do all that? Why can't you do it on your own? So that begs the question. So now these are some of the things why one might be interested into getting into a mutual fund house. One, these mutual fund houses are professionally managed. You have a fund manager who has had years of experience. Okay, we take care of everything in terms of the regulatory body, in terms of the knowledge share and all that. There's ample amount of portfolio diversification. Given
yes, there is a YouTube link going. So if you look closer to this, the sound will be better.
Is this a mic?
This, closer to this. Done.
Sure. So what are the benefits of mutual fund? One is, of course, it's professionally managed, and we give you a lot of portfolio diversification. For the sum that you can invest into, say, one equity stock can be split up into different avenues, different stocks. So basically how a mutual fund works is we give you units of that stock. So if there is a stock, we split it into a number of units, and you start getting 1 unit of that. So your exposure, you get an exposure at a much lower price point, right? So you have a lot of portfolio diversification. Of course, these investments tend to be extremely tax efficient in terms of, okay, we'll have to talk about tax. So in an equity investment, if you do an equity investment and you hold it for more than a year, your returns are tax free. Whatever profits that you make in an equity investment becomes tax free. If you hold it for less than a year, there are tax implications. Of course, it is on the profit, and it comes down to something around 18% of the profits that you've made. When you look at a debt space of investment, for any investment that you make for less than 3 years, that gets taxed according to your tax slab. And anything beyond 3 years, if you hold an investment for more than 3 years, you get taxed at 20% after indexation. So there are tax benefits of investing into a mutual fund as well. There's ample liquidity, and like I said before, there are a variety of options. So different people have different expectations, and we have an offer, or a mutual fund house will have a fund that serves all the various demands and the requirements that will be in the market. Now, one of the reasons why I'm here today is to give you a brief market outlook. And this is somewhat what an ICICI Prudential has. Of course, the slide says monthly market outlook, but you can pretty much extend it to the next 1 year, 2 year horizon, because the market outlook seems to be very positive. So the lines are very clear. Equity investments for long-term wealth creation, fixed income which will build on the rate cut cycle that we're currently looking at. So why invest into equities? Now, let me just give you a disclaimer. As a fund house, and I'm sure most of the fund houses will agree with us, is that we will request customers to, one, invest with a long-term view. Do not come and invest into equities with a very short-term view. Please come and invest with a long-term view. And secondly, have a moderated sense of what your expectations are out of the market. Which has given you, say, 50-60% in the last 1 year. Please do not come back saying that I want 50-60% in the next 1 year, because your expectations at such peaks should be a little moderated. That's broadly what we expect. Come with a long-term view, and also come with a moderated sense of expectation out of your investments. But why do we think? Why are we still saying that equity space is something that you can invest into? So these pointers, so the three reasons that we have highlighted over there. One is a stable macroeconomic situation of the country, right? In the following slides, I'll show you what I mean by that. Secondly, is the prudent fiscal and monetary policy. So when I say prudent fiscal policy, what I mean by that is, if you have heard any of the Prime Minister's speeches, you'll always hear him talk about how he wants to build new roads and bridges, how he wants to create 100 smart cities, how he wants to bring electricity to every corner of the country. Now, these are things that no man can do in 1 year. For the matter of fact, you can't even do it in one term. You need to have 2 terms at least to be able to achieve these. So the government is not making plans or making goals which are very vote focused, right? They are taking a very prudent approach of their plans. Now that also is reflecting in the way RBI is working. So a small example that I'd like to take from this is just the month after demonetization, right? So the expectation in the market was, because of demonetization, liquidity will get sucked out of the market. Now, once that happens, people will in effect have lesser money to spend. When they have less money to spend, consumption in general has to go down, and that will adversely affect the GDP. And this was a general news that because of demonetization, GDP is going to get affected. Right? At that point of time, the very easy solution that RBI could have had in its hand is to reduce the repo rate. Because of that, in general, the interest rates go down, more liquidity in the market, your GDP gets stabilized. But the RBI took a very prudent approach. It said that, okay, demonetization has happened, but the effects of demonetization will wear out. And they stood their ground and did not reduce the interest rates. And subsequently, we saw that we were running at something around 7.4. The GDP was 7.4 before demonetization. After demonetization, it was roughly around 6.1 to 6.3. So it did not have adverse effects, and it was a good decision taken by the RBI as well. So both the policy makers are taking very, very prudent approach in terms of the policies that they take, both the government and the RBI. And such, when you take such long-term views on the planning that has been done, we believe that the markets in general will do good. So we believe that the economy will do good, the country will do good, because of which the economy will do good. And when the economy does well, your equity markets in general tend to do very well. Right. So in broad perspective, we say that the markets will reach new highs in the next 2 to 3 years. But having said that, I will have to be absolutely blind to tell you that there are not going to be any pockets of corrections in the market. There are bound to be pockets of corrections. You look at the amount of liquidity that is in the market. So if you look at the month ending July, if you look at the kind of foreign inflows, we have had net foreign inflows have been something around 1,500 crores. So to give you numbers, it's been 1,05,000 crores of purchase and 1,03,500 crores out of redemptions. So there's a net of 1,500 crores of purchase by foreign investors. And Indian investors have been doing 3 times of that, right? 4,500 crores of net investments have happened in just the month of July, just 1 month. And the story kept on repeating for the last 6 months. So you have ample liquidity in the market, right? And if the third line that reads is price to earning ratio can be higher as we go along. So what does that mean? What I mean by that is, what you think is expensive today may not be expensive in the future. Okay, I'm not going to name the stock, and I'm sure you will be able to relate that stock. But there was this one stock of one bike maker, right, which was trading at 20 rupees in the year 2002, but 20 rupees ke kareeb wo trade kar raha. Today, that stock is trading at around 27,000 rupees. So in 17 years, that stock went from 20 rupees to 27,000 rupees. Now, this is an exaggerated one of the examples that I'm giving you. But just think of the psychology of the investor. That 20 rupees someday became 200 rupees, right? The investor must have been very happy that 20 rupees got 200 rupees, so you got 10 times of your investment. Some would have left booked their profit, some would have stuck by. Rupees someday became 2,000 rupees. Now this is unimaginable. 20 rupees ka stock has now become 2,000 rupees. But that 2,000 rupees someday became 20,000, and that 20,000 today stands at 27,000 rupees. So now if you come and tell me, would you buy the stock at 20,000? Yes. What you once thought was expensive at 2,000 is no longer expensive today. So that is, and why do I keep saying that, what once was expensive will no longer be expensive, is because of this chart. towards the physical savings. What has happened is, of the last decade, we see that people have started moving away from tangible assets, the things that you can touch and feel, like gold and real estate. Right? People have started moving away from gold and real estate and started investing into financial avenues of investment. Economics dictates that when you pretty much have the same amount of supply, but you have more and more participants in the market, the demand goes up, subsequently the prices also go up. So we feel that the markets in general will go up in the future. These pockets of corrections. Set the entire, so everybody understands that markets go through cycles. There are peaks, there are bottoms, and there are the net zeros, right? So if I have to plot it into a cycle, where are we? Are we early in the market? Are we late in the market? Are we right in between? As a fund house, we believe that we are right bang at the center. We are in what we call as a mid-cycle. What happens in the mid-cycle? Right? What happens in the mid-cycle? People start forgetting about this thing called as asset allocation. When I say that, to put it into very simpler terms, I mean that people start forgetting that do not put all your eggs in one basket. Because that one basket seems so attractive, people start putting all their eggs into that one basket. Right? So, like this graph shows you, everyone started to move towards the equity markets. This graph again, I skipped. It tells you that when the markets are rallying up, people start infusing more. Everybody wants to make hay when the sun shines, right? So when the market is going up, everybody is putting more and more money. When the markets are coming down, everybody wants to book profit because obviously if the markets are going down, you want to book profits. But that, if you ask a smart investor, he would do the complete opposite. When the markets are going up, you should be booking your profits, right? When the markets are going up, keep booking your profits. When the markets are coming down, keep infusing more and more money into the system because in effect you get more and more of what you've invested in. So that is precisely what we do in the dynamic asset allocation funds. When the equity valuations go up, we reduce equity exposure.
So I think, Jaideep, just for the benefit of the audience, if you can just take a little feedback of the audience,
Sure.
how has been their investing in experience, investing in markets?
Okay.
Was it always a very smooth ride?
So just one question: how many of you? I'm assuming all of you invest, right? Yeah. So how many of you are happy with your one-year investments?
Sure.
Huh?
I am the
You are not happy. Okay. So you are not invested at least.
Not in last 6 months.
Okay.
I missed that goal. So had I invested earlier, I would have made some profit. An emotional loss that I have not invested, so I've lost this.
So what is, if today you have money, what is your feeling? Can you invest in markets today?
May not be the whole money, but I would invest in part of the money and hold to see the correction and then reinvest.
Okay. So you are concerned, you don't feel today you can put all your money in the markets.
Yeah. I am skeptical in the valuation.
Mr. Yadav, do you have any inputs on markets? What do you feel if you have money today? Would you like to invest all your money today in markets, or you would wait and watch or something?
Would like to invest not all the money, but at least 50%. What I feel safe, I will invest in. I've been having kind of this thing that kind of money that I can just put it in some place and forget about it.
Sure.
That's the kind of money I would like to put it in the market.
What are the return expectations? If you are looking at returns, what returns gives you?
At the end of the day, markets have given higher returns than the banks.
Sure.
So it depends on the macroeconomic situation given at that point in time or during that period. It will be in line with that. I can't say that.
How much better than FD is your expectation? Let's say
maybe 12-13%.
That is something. Sure. Kamath, you want to share something?
Investments are very less,
Right.
but maybe 30-70. I would like to invest 30 or 40
Into the equity space,
Yeah.
and the remaining would be into how would you like to allocate your assets? If I ask you as an investor, just an example, you suppose you have just 100 rupees, 30 rupees has been put into the equity space. Where would you find comfort in putting the rest of the 60 rupees?
I think he's not an investor, active
Not much,
investor.
yeah.
It's more of a fixed deposit, so you have to convert him.
Okay.
So I think that's your job. Yeah.
So part of this Thinking Man series is, I believe, to enlighten and tell you what the market situation is and how do you. See, most of the things that I've already spoken about is just raw data, right? And now, how do you convert this data to actually being able to make money out of it? Is what this entire program is all about. We'll give you raw data. How do you use it is also something that will help you out. But actual implementation is what we'll have to take care of. So any other guys? So how many of you are very happy with your investments in the last 1 year? Whoever have invested, stayed for the last 1 year, entered last 6 months, and you're very happy or happy with your investment. How many of you?
Yeah.
So what happens is when there is so much euphoria in the market, you should start to probably start thinking of booking. Problem I face is that whenever I see that my stock has done really well, I'm able to sell it, thinking that it will climb a little higher tomorrow. Coming down, I'm still not able to sell it, thinking that I saw it at say 130 yesterday, it's at 120. It'll come up. I'll sell it when it's at 130, and it comes 130, and still I'm not able to sell it. So you get locked wherein greed and fear takes control, and you're never able to exit out of it. That fund, the dynamic asset allocation comes into place. Now, the slide shows that when the equity valuations go up, we will reduce equity exposure, and when the equity valuations come down, we will increase equity exposure. Let's proceed and check. So, yeah. So equity markets. So this is how one would imagine, how you should actually tackle the situation. So you should be invested in such a way when the market is coming down, limit your downsides. If the market is coming down, of course, if you're invested into equity, there is some downfall that you will see. But the main agenda over here is to be able to limit your downsides. So really, you should be able to create wealth along with the market, right? So funds, and of course, this is just an example to show you how the dynamic asset allocation works. But this is just an example. BAF, as a balance advantage fund, play the downtrend. The rightmost corner. So Sensex at 29,000 on the 9th of January. How much equity did we have? We had percent equity. Yeah, we had only 34% equity. The moment the Sensex moved 1,000 points lower at 28,000, I'll just point it out to you. 29,000. When it was at 29,000, we were holding only 34% equity. When the market was heavy or hot, we were holding only 30%, 34% of our investment into equity. The market went down by 1,000 points, we increased our equity exposure. Down another 1,000 points, we increased another 5%. Going lower and lower, we started increasing more and more into the equity space. So you see at 29,000, we had 34% equity. Down by say 5,000 points, we were standing at 74% equity. Okay. So now the question, and let's see the other way around as well. What happens when the market starts to come up again? So at 29,000, market playing uptrend, right? Yeah. So at 29,000, net equity at 54%. Okay, my bad. But 25,000, we were at 62%. And when the market starts to go up, we kept on, booking profits. When the market started going up, we kept on booking profits. So this is a basic cycle that we play. Market keeps coming down, we infuse more and more equity. Market keep going up, we start booking profits. But what do we do with the money that we have not invested? So when I said when the markets are, going up, I keep booking profits. But what do I do with that money when I keep booking profits? Allocate into different assets. Predominantly being debt or fixed income is a space that we look at. We have funds, and the competition also has funds wherein we look at arbitrage as a space to park money. We'll look at probably debt as a space to park money. We'll also look at gold or some tangible form of assets where we can park money. So the idea is attractive, infuse more money, booking profits, you start allocating into different asset classes. Have I been clear on this?
Before the specific product which he is just mentioning, we are talking about a strategy. So this is like a concept, dynamic asset allocation. We are all here today to discuss more about this strategy. When the markets are down, which sells when the markets are high. This is what the legendary investor Warren Buffett has always said, and he is doing it all the time. That I think 2008, when everybody was so pessimistic that world is going to end, I think at that time he has purchased a Bank of America, and today it's a jewel. He made billions out of that. So how, as a normal investor, what you can do? Because you know when the market is euphoria, 2000 Ketan Parekh time, every panwala or every nook and corner, I'm sure you must have seen Harshad Mehta time, Ketan Parekh time. Everybody was so euphoric, like everything is so good, and people get at that time, and accidents happen. At the same time, when there is a bad run, everybody talks negative. This is a place to avoid, but it works reverse. When it is worst, at that time you need to be very aggressive, and at the time when it's peak, you need to be cautious. So, is there a concept which can give you the be taken care at that time? That's where this dynamic strategy works. And under that, in industry, there are 8 different schemes which are working under dynamic. They have also one of the schemes which are working. We thought as a concept, if we can know more about it, it could be very helpful for us to take some decisions.
So again, one important point is that the fund manager does not blindly take positions as if it's not that when he sees the market falling, we don't blindly take, we don't blindly calculate as to how much equity we need. We use the ratio called as the price to book value. Fundamentally, it gives you what's the price that it is trading at with respect to the net asset of the company that we are looking. So the range that an ideal price to book value company would be comfortable with is between 2 to say 4. That is the range that we are comfortable with. When the range starts to hit 4, that means the market has started becoming a little cheap. When it starts trending towards 2, it has started increasing versus the price. So we start increasing more and more allocations at that point of time. The model that we use is a price model.
Valuation model. Price to book value is nothing but a valuation. Like rental yield is a valuation concept in real estate. Price to book value, price to equity, price to earnings. These are various concepts of valuation. I think the audience, we should avoid a little jargon because they can feel a little away from the concept.
Correct. So this is one of the examples that I want to give you. I'll give you one more example why we keep pitching about dynamic asset allocations. So this is another fund that I'm talking about, and this is showing you the 18-month. Basically tells you if anybody invested into BSE for 18 months, the kind of returns they have got. Because anybody who's invested into an 18-month BSE, this is broadly what the investments that they got. So you can clearly see there are points where they made good money, there are points where they did not make any money. Right now, if you go and compare it to a pure 10-year GSEC, basically you're giving a loan out to the government, right? The safest person that you
like a fixed deposit. You can assume it like a fixed deposit.
Correct. If you assume it as a fixed income source, the orange line represents that. Times when the FD, the fixed deposit, has given you good performances, the equity did not, and the vice versa happens. The equity has given you good performance, but the fixed deposit has not. Where do you go? Right? You can't be. So, do we have a scheme or do we have a strategy that just helps you get cut through them? Imagine what if I take 80% exposure into the debt space and only 20% exposure into the equity. So basically, you have 100 rupees, you put 20 rupees in the equity and 80 rupees in the fixed deposit. So this is what happens. You cut right through the middle. And you will not make the peaks of what the equity has given you, I'm telling you, you won't make the bottoms that these guys have made. You cut right through. So the next slide tells you what happens. So here, either of them, if you had been invested, you would have had a bad experience here, here and there. But throughout, a combination, a strategy wherein you keep allocating your assets cuts right through in between. So that again is what is the kind of return. So minimum return. And here the basic idea, I am aware that my fund is showing some negative returns. The market is unfavorable. You make lesser losses as compared to the competition. And the maximum returns, you make more. I am not assuring you that we'll always make more, but you'll be very competitive as compared to what the maximum has been made. So the idea is to limit your downsides and help create wealth when the opportunity rises. You can also see the average returns. So that those are all, again, returns are very indicative of what has happened. But the strategy stands true into the future as well. Any questions over here? I'm sorry.
So I think you can just quickly show a 2008. I think this was like in all investor minds, this was the year everybody knows this has happened. You can see market was at its bottom. How much equity we were invested at that point? So this is a strategy. So we'll have to work. But we were aggressive at that time, right? When the markets were down. 2013 again, that was the time India was called like a fragile five. There was a lot of challenges, current account deficit and all those things. We were aggressive. When there was everybody was talking bad at that time, there were high equity. Like in 2015-16 we peaked. At that time I think we reduced equity, correct? Yeah.
So the basic idea is when there is bloodbath on the market, put more money. When everybody is euphoric, start putting profits. So that is the basic agenda.
But as an investor, it's very difficult for you to do that because you are always thinking, what? I think all newspapers are talking nonsense. Everybody is talking. All my friends are telling us market is the worst place to be in. What do you do as a person? But you have to generate positive returns. End of the day, 3-4% more than fixed deposit because fixed deposit will not be able to beat inflation. Rate today, Mr. Kamal? 7%? 7%. And let's say if you are in a highest taxation slab, what do you end up making? 3%, 4%?
Yes.
What is the inflation? Growing at 7%? So you are net negative.
Yes.
So you need something which can give you return. So what are the options available with you? Which can give you downside protection also, at the same time can give you high growth also. Your CAGR returns?
So the 5-year CAGR would be something around 16 to 18%. Again, let me give you a conservative number at 15%, but that is the 5-year CAGR that will make in one of the dynamic asset.
My expectation is 11 to 12%. One can look at with a 5-year view post tax coming. Post 1 year, it's a tax-free thing. So that makes it a pretty attractive strategy according to me. Anybody who is doing fixed deposit, look at this strategy.
So that's the one benefit that you get is because see, when I say that I'm going to get into a debt space, it does not mean that you get taxed according to your debt tax slabs. It will still qualify as an opportunity of investing into equities, enjoying the rallies, your downsides by getting into debt space, and at the same time getting equity taxation. So after 1 year, whatever profits you make are completely.
FD में जो पैसा आपको मिलता है सब पे 10% TDS कट के आता है. At least we can make tax-free money because 3% you save just by tax also. Benefit.
Is just what a normal dynamic asset allocation fund basically does. So these guys, since they are in general a little conservative in their approach of investment, they will only invest into large and mid cap stocks. Okay, they will not go into alpha generation of small caps. They will only invest into large, and again they will predominantly be little large cap buyers. They will constantly move their equity exposure. So, for example, this fund, it will move its exposure on a daily basis, depending on where the market is. On a daily basis, it will keep moving its equity exposure. Use certain arbitrage positions to be able to limit the downsides, or just park money if you think there is no opportunity, the market is not going well. You just park your money into an arbitrage space. So these are some of the things that, in general, a dynamic asset allocation fund will do. For example, we have 4 types of dynamic asset allocation, and this changes from every fund to fund. So the similar case will be across the industry. So you'll have to get to the details of how they operate. So this is how the entire strategy. The blue line basically tells you what kind of equity exposure we were having, how much were we invested into the equity space. This is the price to book value. For the ease of understanding, imagine it to be the Nifty levels, right? Nifty index levels. Just imagine it like that. Almost create a mirror image. When the Nifty goes up, I reduce my equity exposure. When the Nifty comes down, I start increasing my equity exposure. So we always follow the mirror image of how the market. This is a calendar year performance. Again, I would appreciate if you could just forget about the brand name right now. The fund is 10 to 11. That calendar year is 2 years. I'm sorry. 2 years, 9.91. So of course, that fund, the Sensex made more, performed better. Of course, that is because any dynamic allocation fund, entire money into the equity space. Talking about will have at most 80% into the equity. Even when everything is favorable, the maximum equity that I can. So there is still 20% of debt over there. That is just for the conservative approach that we follow. But even then, I'm hardly behind a pure equity index. What really excites me is this. From April 1st of 11 to 12, near about 5.5%, down near about 11%.
So that's what our worry is, right? This year, if you were invested, 11% आपका capital loss होता था. Is there a strategy which can and give me positive return? Because if you are able to tide that run, I think then जब भी market बढ़ेगा वो तो आपको मिल ही जाएगा. Important part.
So to give you very attractive numbers, how I would read it is, I have given you near about 16% alpha over what the index has done. Right? I would have been, so that is the limiting factor. Whenever the market goes up, we help you create wealth. Whenever the market, we help you limit. So this is broadly crux of what any fund house will try to do with their asset allocation.
So in 16, they've not given that great return. Correct. But you can see in that year, market was also down 10%. Yes. But they were able to protect the capital. Average those 6 years, averaging that will give you that 15, 16 generated. So again, this strategy need to be looked with a minimum 3-year horizon. Because you could have a year which is very bad. At better than fixed deposit return. What is our objective? Objective is better than fixed deposit. So you will do well if you have a 3-year horizon in this strategy.
Yeah, perfect. It's a 3-year rolling, and we have pitted it against the BSE Sensex. So what this graph is basically telling you is, if you were invested, if any investor was invested for a minimum of 3 years, means aaj invest kiya, he stayed put for 3 years, you have always had better experience as compared to your Sensex. You've always had better experience while taking lower risk and competing against a more aggressive index. And the next slide will broadly tell you what is the number. So was invested with us. So I'll again give you a right. So we have had 1,062 customers, right? We have taken a sample set of 1,062 customers. And what we would have made is 6% year on year. 25, the average is 15%. And this, I think, would attract your attention. Negative returns. The number of people have made between and above. Right. Again, having said all this, it is that all this is all what has happened in the past. I am very confident that if you stay invested for 3 years in this list, you will not feature in this list. And as long as you do not feature in this list, you would have outperformed your FD returns. And that I think broadly is the agenda. And more or less, I think you would feature in the second, third, the fourth and the fifth list over here. Suppose is broadly what I wanted to convey. Yeah. Is there anything else that should be added?
Yeah, I think anybody has any questions.
Yeah, if you have any questions in terms of the functionality or any terms of you would need.
I think any data on month, wherein you have live months data and the months where the actual month, at that month, how this strategy has done.
So I think I might have that in my laptop. So I'll just check. Give me a minute. In the meanwhile, if you have any other questions, please feel to shoot.
So what's your view in the third scenario? When the markets are going up, they've already crossed 12,000. So, like today I have equity investment of say 1.5 lakh rupees, which is broadly in banking space, starting from HDFC Bank, HDFC Limited, Birla, which Aditya Birla, all those banking space, then some Core India, and some non-other this. So should we start booking? And if I book, then where to invest? Because what is the predominant fear is that when market come down, and where?
So let me try to address in a very different way before getting a market piece. What is your purpose? कहाँ जाना है? Where you want to reach? What is this purpose of this money?
Making better returns.
Better returns, right? That is the purpose. And so I feel first of all identifying which risk stage you are. If you are a very high risk stage investor, I think as he clearly mentioned, it's a mid market cycle where we are right now. So we continue to believe that market should do well over a next 2 to 3 year time frame. So it doesn't look very high on valuation. It could further give good thing. So with that point, I think with a 3 year mindset, you can continue to be invested. But the problem I have seen this as the big challenge. You all are busy professional. It's not at all feasible for you to be in touch with the market. कि कब बढ़ रहा है, कब गिर रहा है. It's an extremely challenging thing. So, is there a concept or strategy automatically keep rebalancing this? कि जब ऊपर जाए तो अपने आप कम हो जाए, जब नीचे आए तब अपने आप मेरी buying हो जाए, without being getting emotional. मैंने get very emotional. A doctor cannot do surgery for his own daughter and son. About it, right? So, as a concept, it gives you that power. It keeps buying when the markets are down.
In fact, so just to add on to this thing, I'll tell you just a personal experience. Being in the mutual fund company itself, last 3 years, I buy direct stocks as well. I buy mutual funds as well. If I compared the performance, actually, the performance of the mutual fund was far superior to my stock portfolio. Because what happens is, even though I'm working in a financial company, that is not my work. So I bought 5 stocks. They have done very bad. So at the end of the day, I've not made any returns also. So what happens is, you are actually a very avid stock picker. I would say mutual fund is the best one. That way, being in a mutual fund, or then for mutual funds, which funds you have to select the right term service.
Any monthly data?
So I have a monthly data, but it is very complex. I'll have to
Okay.
skim it down a bit. What we follow is just ask yourself two questions. Do you have the knowledge? Do you have the time? If either of them come, maybe, please move into mutual fund. And the idea that we give people is if you say again, I give you the 100 rupee example, if you have 100 rupee, always start investing like say 10 to 15 rupees into pure equities or remaining into mutual funds or any other avenue of investment, right? And then evaluate where are you, what are you doing? Are you doing very well in the equity space? Then yes, for all other reasons, you should move your money out of mutual funds and start your own. But if the answer comes out to be maybe, then I think you should hold on to mutual funds. If at all, I would actually recommend if the answer comes out to be maybe that you start allocating more and more into mutual funds.
My answer is no. I don't have time. I'm running
Yeah.
my other pieces.
Correct. So as long as the answer does not cross a very solid yes, then I think you should hold on to mutual fund. And in terms of banking, um, see banking, all the macro pointers that we see, the NPA sound good. Even if I go to very basic such as the demography of the country and because of the entire demonetization factors, very basic points, everything seems to be good. But if you have really made a lot of money, I would recommend that you start looking at booking some profits. I'm not telling you to liquidate your entire position, but book some profits and put it into avenues that you think might explode in the future. So that gives you a point wherein you can go through, like you said, learning on your own experience. So you probably can do that.
So one slide, one sheet, I would like to talk a little. I think for the benefit of our viewers on YouTube also. So this is a little different from what Jaideep has been just talking about. Jaideep has been talking about how can we generate above market returns even in the when the markets are down. That was one concept. But many of you, I'm sure, whom I have been interacting, already shared that. But let's say you have not, I've never shared this with you. I thought I'll talk about it. It's one of the most important concept in investing. And if you are aware of it, I think you have done this wealth creation thing. There are three kind of people in this world. One is poor people, one is middle class people, and the third is rich people. What do rich people do? Rich people, their balance sheet has a lot of assets. Poor people, their balance sheet has a lot of liabilities. So rich people, the asset always ensures some income is generating through those assets, and which are compounding, which are growing year by year, and they don't keep idle money in their bank account. They always ensure that their money is working hard for them. Now, talking about Ashok, can you give your age? What is your age right now? 38. Let's say, give me a monthly amount which you can save, maximum monthly amount you can save. 25,000. Currently, Ashok doesn't know anything. What is the best avenue available where Ashok can invest? Once you generate out of your FDs?
Yes, sir. 7%.
7%. I'm sure you are in a highest tax slab. So what do you make after post-tax? 4.9%. So let's say Ashok keep investing 25,000 every year, gets 5% post-tax. He's just 38, and let's say he's going to retire at age. Let's say for next 5 years we continue to invest like this, and let's say he doesn't have any lump sum money. Future value of this money after 5 years. 25,000. How much he has roughly invested? He's invested almost 3 into 5, 15 lakhs. 15 lakh value is 17 lakh rupees. Just a 2 lakh appreciation. Years. Now, let's say I discuss with Ashok, understand his risk profile. Maybe we look at a strategy like dynamic asset allocation, where my sense is at least between 11 to 12% post-tax kind of returns can be generated over a 5-year time frame. If he is more aggressive and his outlook is little 10-year kind of, I feel he can get into equity. And equity, you look at 30-year market returns, they have delivered around 15 to 17% CAGR kind of return. Assuming he is an aggressive investor and he has a long-term mindset, I think the returns what he can generate is roughly around 14%. Let's say 14%. What is the money Ashok has generated? 22 lakhs against 17 lakh from his post-tax. This 18 is after 8%. We have assumed 8% pre-tax rate. So what is the difference? 4 lakh rupees. अशोक बोलेगा 4 लाख एक्स्ट्रा कमाने के लिए इतनी रिस्क कौन लेगा? Why should I risk my capital? So the point I'm trying to make, in 3-5 years, you will not see any difference by investing in equity. You will say कि अरे यार 3-5 साल के अंदर क्या इतनी रिस्क भी तो ले रहा हूं मैं कल को, तो my capital is also at risk. So what is the option available? I convince Ashok, Ashok, you are 38. You are going to retire at age 60. Your kids are, what is your daughter's age? 4 years. Maybe for post-graduation, he doesn't need that money, at least for 14 years, till she turns 18. 14 साल 15 साल तो तेरे पास आराम से है. मैं अशोक को रिक्वेस्ट करता हूँ और उसको समझाता हूँ कि this compounding stuff is good over a long period of time. He increases his time horizon from 5 to 10. बता ठीक है, मैं 10 साल तक इस पैसे को नहीं देखूंगा. Sorry. What is the value of that money? This 46 is something what he would have generated out of fixed deposit. If he continue to do, being non-educated, he kept doing all what he has been doing. Instead of that, he moved to this. He can generate 65 lakh. So does it look a little exciting कि जितनी रिस्क ले रहा हूँ 20 लाख रुपए मैंने एक्स्ट्रा जनरेट कर दिए by doing nothing? Does it make a little sense now? So after 10 years, this piece will start looking a little better. Yeah. Now, since Ashok has a good time horizon, year call also. Let's see the difference. All this while, how much money has invested? 25,000 every year. 3 lakh is investing. 3 into 15, 15 I need to do. 15 he has invested 45 lakh rupees. With fixed deposit 8%, even with 8% pre-tax, his money will be 87 lakh rupees. Against that, this value moves to 1 crore 51 lakh. Start looking a little meaningful after year. पूछ रहा था मेरे से कि ये मार्केट मेरे स्टॉक है, ये कह रहा हूँ अशोक तुझे पैसा चाहिए क्या? Do you genuinely need this money today? If you don't need this money over 15 years, doesn't it make great sense to stay invested? Because there is a huge amount of wealth. There is a good time horizon. And I'm sure he has been richly compensated for the risk he's taken. 87 lakhs has become 150. I'm almost 15 years in industry. Jaideep can again vouch for that. Investing for more than 10 years, if somebody has invested, he have never lost money. And always the returns have been about 12-13%. Too aggressive. So that noise around us, कि अरे market बढ़ गया, कम हो गया, and all that. Stay away from that. You should focus on this compounding thing. And I call this as power of 7. What you are generating today, that can generate 7% amount of wealth. What we are talking about rich people. Rich people have been doing this only. They ensure all their money has been going in right places. अभी अशोक ने अगर इसको 20 कर दिया, just see the difference. 3 crore 25 lakhs. It's double for it. Against fixed deposit 147.
Yeah.
So this is why it is important. India में अपना financial education and that's very weak. We have been sent to MBA colleges, engineering colleges, but we have never been taught this basic concept. Really help you create. We have been working with clients for years, very disciplined about investing. into market noise has been created over a 10-year period. And suddenly I've seen a lot of. So what is more important? Focus on your goals, which can give you a wealth creation of this kind. Important. Calculate good, but taking risk just like yeah, you're taking risk. You're taking risk. Risk कहाँ पे नहीं है, आप मेरे को बताओ. That generate the ball. Risk is everywhere.
Morning walk or rather than lady die on the road.
Yeah, so everywhere there is a risk. So what is more important? Risk well, and people who understand risk well do well in life. And people who are always नहीं my dad रिस्क नहीं लेने का, बस LIC में डालने का. आप बताइए 15 साल पहले आपके डैड यूज करते थे, आप लोग वो फोन यूज करते हैं. हम लोग समय के साथ सब लोग चेंज हो गए, बट हाउ मच वी आर चेंजिंग इन टर्म्स ऑफ आवर इन्वेस्टिंग हैबिट्स. Big differentiator is you need to change with times in terms of your investing also. So this is I call as power of 7, and you can see what kind of wealth could be created. Another concept is if you delayed by 5 years. अशोक बोलेगा कि I'm 38, लाइफ कहाँ पैसा सेविंग करने का, let me go for a, let me buy the best gadgets, let me buy the best car, let me not get into all that. Avoids this investing for 5 years. तो 20 साल की बजाय अशोक 15 साल ही इन्वेस्ट करेगा. 3.25 करोड़ की बजाय उसकी वेल्थ है to 1 crore 51. A delay of 5 years costed him half his wealth. You have to seed it. अगर आपने 1 साल 2 साल 3 साल डिले, age is running out, right? So it's important to understand and start early and don't delay. So don't keep any extra money in your bank account. Ensure this is allocated rightly. And define your goals. कहाँ मुझे जाना है? Our kids will be someday we need money for their education. हम retire होंगे, हमको एक अच्छा purpose चाहिए to lead a good life, respectful life, parent on anyone. And I think once goals are defined और आपकी risk लेने की ताकत क्या है? अब risk लेने की ताकत सबकी अलग हो सकती है. Have a different perception of risk because he comes from a different background. Mr. Kamath could have a very assessment of risk because he has taken life from a very different way. Which guy could take risk in a very different way. After assessing the risk, I think we come to a conclusion कि हमें ये risk लेनी है. Is define risk level में what best we can do. I think that's the simple way according to me is of wealth creation. Wealth create करनी है तो आपको इसके अलावा कोई तरीका नहीं. It's like a plant. पौधे में आपको रोज पानी देना पड़ेगा, धीरे धीरे बड़ा होगा, एक दिन में बड़ा नहीं होगा. Have patience. And he has also vetted that. Tough time 3 साल किसी ने इन्वेस्ट किया है तो never bad returns have come. पर आप आज डालोगे और 15 दिन बाद चेक करोगे तो I'm saying आपको 5% नेगेटिव भी दिख सकता है. So don't come with a mindset of 3 years. Very good investing experience. Very much for joining. If any questions,
One question.
Yeah.
What's the difference between there are some mutual funds where you get tax benefits?
Correct.
You know, the income tax benefit. And
Correct.
people invest in that. Those and the mutual funds that which are like.
You would like to
Yeah, I suppose you're talking about the ELSS.
Yeah, tax saving, ATC tax
saving.
benefit.
So these guys are equity investors, but they get locked onto 3 years, and that tax benefit that you get can be, so the what your income is from that you can remove 1.5 lakh, and the remaining gets taxed. The tax savings that I'm talking about is a different type. So if you invest in equity space investment, after 1 year, does not get taxed. Two different sets altogether.
But there are people who have funds to get that tax credit itself.
Yes. Suppose there's an individual, his salary say 10 lakh rupees. You don't have to pay tax on the initial 2.5. So effectively 7.5 is the taxable income. If you put it to an ELSS scheme up to 1.5 lakh, if you invest say 1.5 lakh rupees, 3 years.
Yeah.
But for that financial year, instead of paying tax on 7.5, you because you should have 1.5 for an ELSS. Total income 6 lakh rupees. That is only for and that money gets stocked up for 3 years.
Yeah. But my question is, do they have restrictions that they have in program or
Broadly, they will have to do a little blue chip as such that these are the companies that multiple taxation schemes, which is basically multiple levels of risk that they're comfortable with. Mandate as such, but predominantly they tend to be like large cap and safer horizon investments.
So 3-year lock-in product. It is just like any other equity scheme.
but does it give the same kind of returns what
Yes, I think they have been generating similar. But if you have a ATC already covered in LIC and anything else, don't get into that. अगर आपका PPF and all those things, anyway your money is there. Why you want to lock in your money
I'm
for?
just asking out of curiosity.
Yeah. But you can always do if you want to use that ATC. One more interesting stuff I recently came across. आप में से सबने real estate properties खरीदा होगा, right? You must have purchased property. Ashok, can you tell me the price at which you have purchased your real estate? Well,
So, I purchased it
1.2 crores. So let's say initial amount what you have put in is, I'm putting 120 here. Okay? And how long? 2010. So it's almost 7 years for you. Huh? I'm just saying. And what is the value of that money today?
2 crores.
2 crores today. Your one point.
Sorry.
Actually, this 1.2 crores has become 2 crores. Year of that 1.2 crores, money has almost less than doubled.
10%.
Less than 10%. Experience has not been good. He's worse than I agree. Fixed deposit. But there are good success stories also. I'm sure you. तो आपने कब लिया था? 82 क्या रेट में लिया था आपने? नहीं, मुझे सब लोग बोलते हैं कि व्हाट आर द डिफरेंट ऑप्शंस अवेलेबल. सोने में डाल सकते हो, गोल्ड में डाल सकते हो आप पैसा, रियल एस्टेट में डाल सकते हो, फिक्स डिपॉजिट में डाल सकते हो, इक्विटीज में डाल सकते हो, म्यूचुअल फंड्स में. ये 5-6 चीजें हैं अपने पास, राइट? सो लेट्स कंपेयर देम इंडिपेंडेंटली. देयर एक्चुअल रिटर्न्स व्हाट यू हैव जनरेटेड 82
4.25 lakhs.
4 पॉइंट आज क्या वैल्यू? ठीक है. कैन यू रेट ऑफ इंटरेस्ट है, रेट ऑफ इंटरेस्ट पे प्राइस नाउ टाइम रेट परचेज how much 82 you have put 28 years you are 17 35 years you are invested say 4.5 lakh rupees 2.220 220 we made 100x. But
You can check mine. I'll tell you.
Yeah.
25 lakhs we invested in Navi Mumbai.
25.
Today it is about 1.1 crore.
sell your property.
In 2006 it was. It was 2006.
You purchased in 2006.
2006.
So we are almost 11 years. Returns are good, 14%. But at the same time, can you get me a Sensex data or let's say a top equity fund or balance fund data? They have delivered anywhere 17%, 16%.
Since inception, 1983, has been around 16.6. The tops and the bottoms that Sensex has seen, it has been around 16.6 odd %. For the matter of fact, that has actually outperformed this. So, can you price now 30 crores?
Price now is
27 crores. 27 crores.
today,
Yeah, today.
27.
Okay, and price back then was 30 lakhs, so 0.30.
Access 0.3. Okay. How much time?
Okay. Since 1983,
35.
35 years. That we had. So what we did is, we took an example that if you had say 30 lakh rupees, right, 30 lakh rupees in 1983, you had an option in the BSE in their index, buying a flat right opposite Bombay Stock Exchange, right? So 1% went and bought that flat, 1% went and what is the kind of performance that they got. So that's why the data comes out to be 16.6% in the Bombay Stock Exchange, whereas the flat has given
Respect and discipline like you give it to I want to sell it because high. You nurture it like that, I think it can become a trade. Important part against real estate. Real estate, आप जब चाहो तो बेच नहीं सकते. Let's say today you go and sell your property. Will you find a buyer today?
So takes time.
Liquidity is a challenge. If you want some money, the property value is 1.1 crore. You say, oh, I need 5 lakh rupees. I don't have money. Let me sell the property. Let me sell my washroom. Can you sell your washroom and get 5 lakh rupees? Yeah.
And also it's a tax liability.
So capital gains taxation is again
These returns, if you minus the taxation part also, it may come a little
of course.
much more low.
So
And-
in real estate, you have something called as indexation benefit, which takes care of the inflation that has happened. But at the end of the day, you have to pay some tax.
some tax.
Equity has no tax on the profit that you make.
And if we can bring a strategy like this, which can reduce that risk further and can give you with a 5 to 10 year, a 12% kind of experience, I think what else you need? I just felt floored कि was if we have something like this, you see this number, आपकी profit बना सकती है. You don't make any, actually you lose money every day. So makes a lot of sense. So think when you're buying a real estate. That's what I'm trying to say. Moving India is to financial asset. I think last 3-4 saying that nobody is buying real estate now.
A year and a half, 2 years back, and the equity assets were 8% of the. So it has actually doubled in the last 2 years, and more it's increasing by the day. 4% post-tax. We cannot digest the fact of 4%.
So आप 4% तो आप एक अच्छी कंपनी का डिविडेंड यील्ड भी लेके आप कमा सकते हो. Thank you very much.
What is the difference
Yeah.
between this dynamic and the balanced? What is it? Featured
Pure balance and a dynamic.
balanced
Okay,
fund
plan,
and balanced.
dynamic plan. So balanced fund, so consider the equity 65 to 80%, right? Whereas dynamic can move it right up to 100%.
Asset allocation.
So dynamic asset allocation is like in that basket I have 4 funds. So it's a category. It's an old category.
But this category, what he's talking about is 30 to 80%. Between 30 to 80%, he'll keep. नीचे में वो 30 पे 80 पे आ जाता है. And a normal balance fund will always be at 65 equity. That has also given very good returns. So you have a higher risk appetite. So let's say if I talk about you, you have good time frame for your retirement. Let's say Mr. Kaman, you, and he says, "Ki Tarun, I'm not looking at something with a 10-year horizon. I'm looking at a 3-year horizon. More sense for him." So based on your time horizon, investing, I think for you तो डाल के भूलने वाला चीज है. So you can go a little more in aggression. Thank you so much.
Thank you.
Thank you, Sunny. Thank you.
Thanks.
Yeah, some feedback from it would be good if you come on this. How can we make these